And imagine investing in a company whose shares skyrocket from £100 to £1,000 in just a few months. Sounds too good to be true, right? This was the reality during the height of the South Sea bubble in 1720. The South Sea Company, a name that would become synonymous with one of the most notorious financial bubbles in history, saw its shares traded several times a day. Like a fever, the share mania infected the nation, with the price of stocks soaring to astronomical heights. Everyone from aristocrats to fishmongers was speculating, buying on credit and selling for profit. The air was thick with anticipation and the promise of easy riches. But what was fueling this speculative frenzy? The answer lies in the intoxicating mix of uncertainty, greed, and the human propensity to believe in the improbable. The South Sea Company had a monopoly on trade with South America, a region shrouded in mystery and tales of unimaginable wealth. The potential for profit seemed limitless, and the public, seduced by the siren call of quick fortune, willingly bought into the dream. However, as the saying goes, what goes up must come down, and so it was with the South Sea Company. The shares, which had risen so spectacularly, began to plummet. Panic ensued, and the dream quickly turned into a nightmare. The bubble had burst, and the fallout was catastrophic. In the grand scheme of things, the South Sea bubble was a stark reminder of the dangers of speculation and the volatility of the stock market. It served as a lesson that the promise of quick riches often leads to ruin, and that sound financial decisions should be based on solid foundations, not fleeting fancies. As we will see, this unprecedented rise was not sustainable, leading to disastrous consequences for many. The South Sea bubble wasn't just a financial crisis, it was a social and cultural phenomenon, a cautionary tale of greed, folly, and the human capacity for self-deception. And its echoes can still be heard today, whenever talk turns to bubbles, booms, and busts. The bubble didn't just spawn a trading frenzy, it also gave birth to some of the oddest companies in history. Imagine a company whose business plan is so cryptic it's practically non-existent. Well, during the South Sea bubble, that was a reality. As the bubble inflated, ambitious entrepreneurs jumped on the bandwagon, setting up companies with peculiar and sometimes downright bizarre business models. One of the most notorious examples was a venture whose purpose was described as carrying out an undertaking of great advantage, but nobody to know what it is. Yes, you heard that right. A company that promised great rewards but refused to disclose what it actually did. Intriguing, definitely. Sustainable, not so much. This strange enterprise raised a whopping £2,000 in just 5 hours. It's a testament to the speculative frenzy of the time that investors were willing to throw their money at such a vague proposal. But this wasn't a one-off. The bubble era was littered with companies promising to make perpetual motion machines, to ship sunshine from the tropics, or even to reclaim sunshine from cucumbers. These ventures, with their outlandish promises and secretive plans, were as much a part of the bubble as the inflated share prices and rampant speculation. They reflected the madness of the moment, a time when common sense was tossed to the wind and replaced with a feverish desire for quick riches. But as we know, all bubbles must burst. And when the South Sea bubble popped, these bizarre companies disappeared as quickly as they had appeared. Their ambitious, if not downright absurd, business plans collapsed under the weight of reality. The investors who had been lured by the promise of quick wealth were left with nothing but the cold comfort of hindsight. The South Sea bubble was a time of wild speculation, of dreams and schemes, and of some of the most bizarre companies in history. But it was also a stark reminder of the dangers of unchecked speculation and the inevitable crash that follows a financial bubble. Of course, these companies were as unsustainable as the bubble itself. The bubble didn't discriminate between the ignorant and the intelligent. Even Sir Isaac Newton fell victim to its allure. A man of science, renowned for his contributions to physics and mathematics, Newton was not immune to the frenzied optimism of the South Sea bubble. He initially invested a modest sum in the South Sea Company, and after seeing his investment multiply, he was bewitched by the promise of even greater wealth. Emboldened, he plunged further into the market, only to see the bubble burst, erasing his substantial profit and a chunk of his original investment. The loss was so great that it reportedly spurred Newton to remark, "I can calculate the motion of heavenly bodies, but not the madness of people." A sobering reminder that even the most brilliant minds can be ensnared by the irrationality of financial mania. But Newton was not alone. Other luminaries of the era also fell into the same trap. Among them was the king's jeweler, Christopher Koch. Known for his acumen in dealing with precious gems, Koch was another victim of the South Sea bubble. He invested heavily in the company, swayed by the glamour of the promised trade with South America. When the bubble popped, he found himself in financial ruin. Then there was Thomas Guy, a philanthropist and the founder of Guy's Hospital in London. Unlike Newton and Koch, however, Guy's story serves as a stark contrast. He was one of the few who managed to cash in his shares at the height of the market, becoming one of the rare winners in this financial catastrophe. These tales of the South Sea bubble serve as timeless lessons. They remind us that no one, not even the most esteemed figures of society, are immune to the intoxicating allure of quick riches. These stories of loss and gain underscore the unpredictable nature of speculative bubbles and the human propensity to be swept up in them. As Newton's experience shows, the madness of crowds can ensnare even the most brilliant minds. At the heart of the bubble was the South Sea Company, a venture promising lucrative trade opportunities in South America. The South Sea Company was initially set up in the early 18th century not just as a trading firm but a political gambit. It was spawned from an audacious plan to exploit the untapped wealth of South America, despite the constant disagreements between Spain and Britain. This was the allure, the siren call that drew in investors from all walks of life. The promise of a monopoly on trade in the South Seas was the bait that hooked the public's imagination and their wallets. The company was clever in their approach. They painted a picture of exotic wealth, of gold and silver flowing from the New World, of a future filled with prosperity brought about by this exclusive trade agreement. The hype was palpable, the anticipation tangible. The South Sea Company was not just selling shares, they were selling dreams. But the reality of the situation was far from what was promised. The South Sea Company was a castle built on sand, its foundation shaky at best. The much vaunted monopoly existed more in theory than in practice. Spain, the colonial power in South America, allowed the company a meager annual ship and maintained control over the ports, severely constraining the company's ability to trade. This didn't stop the company from inflating the value of its prospects. The stock prices soared, not based on actual earnings or potential, but on the fevered imaginations of the investors. The company kept the illusion alive, spinning tales of untold wealth just around the corner, keeping the investors hooked. The weight of reality, however, could not be denied forever. The trade monopoly turned out to be more mirage than reality. The promised gold and silver were nothing more than dust. The South Sea bubble burst, the company's shares plummeted, and the dreams of untold wealth evaporated. As it turned out, the company's promises were as empty as the bubble itself. Shockingly, the British government was not just a bystander in the bubble, but an active participant. You see, in the early stages of the South Sea Company, the government was heavily involved, but not in the way you might expect. They weren't regulating or overseeing, they were actively fueling the speculation. Let's get into the nitty-gritty of it. The government held high-interest bonds, essentially debts it owed that carried a hefty interest rate. Now these bonds were a burden on their coffers, so they came up with a rather ingenious plan. They exchanged these high-interest government bonds for stocks in the South Sea Company. This move was like swapping a guaranteed loss for a potential gain. It was a win-win situation for the government. They reduced their debt load and simultaneously acquired a stake in a company that was, at the time, seen as a golden goose. It was this very action that inadvertently promoted the scheme, giving it a veneer of legitimacy and government backing. The public, seeing the government's involvement, were convinced of the company's potential. After all, if the government was investing, it must be a sure thing, right? This led to an increased demand for shares, driving up their price and inflating the bubble further. But the government's involvement was not without repercussions. When the bubble burst, they weren't spared from the fallout. They had exchanged their steady, though burdensome bonds for shares in a company that turned out to be massively overvalued. The financial loss was significant, and the public trust in the government took a hit. In retrospect, the government's involvement was a classic example of the dangers of unchecked speculation and the absence of proper oversight. Their actions, though well-intended, played a significant role in creating and inflating the South Sea bubble, leading to one of the most notorious financial disasters in history. The government's involvement only served to inflate the bubble further. And when it burst, the consequences were felt far and wide, from the halls of power to the humble homes of the common folk. The bubble was not just a financial disaster, but also a source of inspiration for some of the era's greatest writers. The South Sea Bubble, a financial catastrophe of epic proportions, offered rich fodder for two literary maestros of the time, Jonathan Swift and Alexander Pope. Swift, an Irish satirist, was renowned for his biting wit and keen social commentary. When the bubble burst, he capitalized on the opportunity to lampoon the greed and folly of the era. His pen was as sharp as his wit, and he took no prisoners in his satirical assaults. He wrote about the absurdity of the situation, how ordinary people were swept up in a wave of uncontrolled speculation and the disastrous consequences that ensued. His weapon of choice? Irony. Swift's pointed commentary on the bubble served to underscore the recklessness of the time, and his words still resonate today, reminding us of the potential dangers of unchecked greed. Alexander Pope, another literary giant of the era, was equally inspired by the bubble. Known for his mastery of the heroic couplet, Pope used his poetic prowess to create incisive satires of the event. His work, The Dunciad, is a biting critique of the mindless speculation and irrational exuberance that characterized the bubble. In this masterful satire, Pope equates the investor's blind faith in the South Sea Company to the worship of the goddess Dullness, a deity of stupidity and dullness. This potent metaphor served to illustrate the sheer insanity of the situation and the public's willingness to blindly follow the herd with disastrous results. What Swift and Pope managed to do was to immortalize the South Sea Bubble in literature. Their satirical works serve as a timeless reminder of the dangers of financial speculation and the human propensity for greed. They turned a financial disaster into a powerful social commentary, highlighting the folly of the age and the madness of the crowd. Through their works, these writers immortalized the bubble as a cautionary tale of financial folly. The bubble's burst led to more than just financial ruin. It also brought about significant legal changes. In the wreckage left by the South Sea Bubble, the British Parliament sought to control the chaos with the introduction of the Bubble Act in 1720. This legislation was a direct response to the financial disaster, aiming to curb the unrestrained speculation that had fueled the crisis. The Bubble Act was a significant legal shift, marking a new era of regulation in the financial world. It imposed restrictions on the establishment of joint stock companies, a structure that had been manipulated in the lead-up to the bubble. Essentially, it meant that such companies could no longer be formed without the approval of a royal charter. This was a dramatic change. Before the Bubble Act, anyone could set up a joint stock company, pooling capital from investors to fund a business venture. But in the aftermath of the South Sea Bubble, the British Parliament recognized the need for stricter controls. The aim was to protect investors from unscrupulous schemes and to prevent the reckless speculation that could lead to another financial disaster. The impact of the Bubble Act was profound. It effectively stifled the growth of joint stock companies for a century. This was a double-edged sword. On one hand, it reduced the risk of another catastrophic bubble. On the other hand, it limited the opportunities for businesses to raise capital and expand. The Bubble Act was eventually repealed in 1825, but its legacy lived on. Its principles of regulation and oversight continue to shape financial legislation today, reminding us that while the pursuit of wealth can drive innovation, it can also lead to ruin if left unchecked. The Bubble Act served as a belated attempt to prevent future financial disasters like the South Sea Bubble. The South Sea Bubble may be a historical event, but its influence can still be felt today. In the realms of finance and economics, it left an indelible mark, giving us the term bubble to describe situations where asset prices far exceed their intrinsic values. The South Sea Bubble was the epitome of such a scenario, with investors caught in a frenzy of speculation, driving share prices to astronomical heights, only for them to crash spectacularly. This event serves as a stark reminder of the dangers of speculative investment. It exposes the precarious nature of markets driven by hype and speculation rather than sound financial fundamentals. The South Sea Bubble was a moment in history when the collective madness of investors led to an economic disaster. And this is a lesson we carry forward into today's financial world. The bubble phenomenon is not confined to the annals of history. In fact, it has reared its head numerous times in more recent years. Think of the dot-com bubble at the turn of the millennium, where internet companies with little more than a website and a dream saw their stocks soar, only to crash when the reality of their business prospects set in. Or the housing bubble of 2008, where property prices were inflated beyond their true value, leading to a global financial crisis when the bubble burst. The legacy of the South Sea bubble is a cautionary tale for all investors. It warns us to be wary of investments that promise quick riches, and to always question whether the price of an asset truly reflects its underlying value. It implores us to remember that markets are not immune to the whims of human emotion and irrationality. The South Sea bubble also reminds us of the role of government and regulation in protecting investors. The aftermath of the bubble saw the introduction of laws designed to prevent such a disaster from occurring again. As the South Sea bubble shows, when it comes to investing, what goes up must come down. We would do well to remember this the next time we're tempted by the allure of a hot investment trend.
Thank you for your time. If you enjoyed this video, make sure to like and subscribe to Financial Ruins to get more educational content. Got a topic you want us to educate people on? Comment below and we'll get right on it.